Welcome to Sprott Media. I'm Albert Liu. I'm joined now by James Rickards. He is the author of the best-selling book Currency Wars and also Aftermath: 7 Secrets of Wealth Preservation in the Coming Crisis. We're pleased to be welcoming James Rickards back to the 2020 Sprott Natural Resource Symposium. James, it's great to catch up with you again. How are you?
I'm fine, Albert. It's great to be with you.
Your book, Aftermath: 7 Secrets of Wealth Preservation in the Coming Chaos. Looks like we're getting a little bit of a look at that chaos right now. We have the trade war, which you predicted last year. We have impeachment. We have an election. Is this some of the chaos that you sort of thought about when you wrote your book?
Well, Albert, I would take all the events you described and others, and maybe some more yet to come. Actually working on a long article right now that kind of brings readers down to the present moment, literally in the middle of the impeachment situation, but takes the story forward through the rest of 2020, because this is not going to let up. But I would take all those things and put them on the list of potential catalysts or potential stress points. But that's not quite the same as saying that's what causes a financial collapse. There's always a catalyst. So you strike a match, but the forest fire isn't caused by a match. It's caused by all the dry kindling and the dry wood and the state of the forest and all the things around us. So yes, it could start things going, but you need a set of conditions for that to turn into a financial panic, or even just a serious market correction or prolonged recession. There are a lot of different bad outcomes. They all have slightly different characteristics. So what I focus on in my book, and you're right, these things can be catalysts. What I focus on in the book Aftermath is what I call the dry kindling. What are the conditions? What is the state of play in capital markets as a whole that could cause a small thing to turn into a significant financial collapse? And there are a bunch of them. We can explore them, but the rise of passive investing at the expense of active investing, the rise of robotic trading as opposed to human interaction, the dominance of I have a whole chapter on Richard Thaler and Cass Sunstein. They're the authors of this book, Nudge, talking about what they call choice architecture. Choice architecture is a way of manipulating behavior by framing choices in a certain way. It kind of looks like you're getting a choice, but you're really being steered in a certain direction. So to the extent that banks and insurance companies and fiduciaries use those techniques as suggested and recommended by Thaler and Sunstein, forces everybody in the same direction. And is that the right direction? I raised the question, what makes them so smart? I understand Thaler won the Nobel Prize and Cass Sunstein was at Harvard and worked in the White House. But just because you have a very high IQ doesn't mean you have any common sense, and definitely does not mean you understand the complex dynamics of capital markets. So these are some of the things, and there are many others. Modern monetary theory, what's going on in cryptocurrencies. I talk about all these things in the book, but these are things that are there. You can identify them. You can pick them out. Too many people ignore them. Too many people just kind of overlook them or take it for granted. But most, I think, the most dangerous aspect is that people don't understand how this is adding fuel to the fire. How when a catalyst does emerge, things will fall a lot faster, a lot harder than anyone expects.
Now, wouldn't you agree that a trade war, an all-out trade war with China, could in fact be a serious catalyst? I'm wondering, we're 2 years into this thing. The president just signed what they're calling the Phase 1 trade deal just moments before we got on this call, James. I'm wondering, how serious do you think it could have been? And then it looks like this is not by any means over. Do you feel it's a significant threat or could be a catalyst?
Well, I agree it's a big deal. I agree it's not over. I think you're right about those two things. And with the Phase 1 trade deal, there's a lot less there than meets the eye. Look, China was being backed into a corner. They needed to save face. Trump has an election coming up. He needed to calm things down a little bit. If you look at the stock market action in 2019, and of course it was a great year for the stock market, but you could tell what was going to happen every day. If there was a bad headline on the trade wars, stocks went down. If there was a good headline on the trade wars, stocks went up. If the Fed was hinting about easing, stocks went up. If the Fed was hinting about tightening, stocks went down. So those two drivers, Fed policy and trade wars, which flip-flopped all year. I mean, just you look at the 365 daily headlines, you'll find half of them were bad, half of them were good. And same thing, the Fed flip-flopped a couple times from the end of 2018, really through until today. So that's what drove the stock market. But as far as the trade war itself is concerned, I think it was a good thing, long overdue. It hurt the Chinese much more than it hurt us. People don't, it gets a lot of headlines. So if you're in a certain industry, if you're Boeing and you're trying to sell aircraft, if you're Apple and you're trying to import iPhones from, China to the United States, if you're Huawei and you're trying to break into 5G in the U.S., which they can forget about, they might as well just pack their bags and go home. Yeah, I'll agree that specific companies could be affected in a material way by specific tariffs, although Tim Cook did a good job of spending a lot of time in the White House and getting exempted from almost everything Trump did. So yeah, there were those I'll call them micro effects, but in the big picture, it's not that big a deal for the United States. It is a big deal for China. The U.S., net exports are just not a big percentage of GDP. The U.S. economy is driven by consumption, business investment, to a lesser extent, government spending, and then at the end, you got net exports. Okay, it matters. It can take GDP up or down a little bit, but you have to look at net exports, so it's not even gross imports, gross exports. And as a percentage of total GDP, it's really tiny. So it has a marginal effect. But then you have to remember all the tariffs we were collecting. And then the mainstream economists get this completely wrong because most of them hate Trump. So if Trump's doing something, they're against it. But remember, go back to 2018 and even later in 2018 when Trump was dialing up the tariffs, what did everybody say? And then this continued through 2019 as well. They said, well, these costs, the Chinese aren't paying the tariffs. They're going to be passed along to consumers. Consumers are going to get whacked. Retail's going to suffer and inflation's going to take off. None of that was true. That's what they said, but it was all wrong. Consumers haven't paid the tariffs. Retail sales are extremely strong. Christmas season was great. There's no sign of inflation. In fact, we have disinflation. Inflation metrics are dropping. There is no evidence that these costs were passed along to the consumer. Now, it is true that somebody pays them, but they point to the importer, the U.S. firm that's buying goods from China. Well, he's the collection agent. Yeah, the importer is the one who's got to, write a check to the U.S. Treasury for the amount of the tariff, but that can be passed forward to the producer or downstream to the consumer, or you can eat it yourself in terms of reduced profit margins. There were a lot of ways that the cost can be pushed around or shared. It's not as simple as saying higher consumer prices. In fact, the evidence is in. We did not have higher consumer prices. Now, who actually pays it? Well, go over to China for a second. What did China do? They devalued their currency. So let's just say you had some goods that were $100. Trump throws a 25% tariff on it. So now all of a sudden, it costs $125 to get it into the United States after you pay the tariff. Well, what the Chinese did by devaluing their currency, they pay their workers in yuan. They don't pay their workers in dollars. They pay them in yuan. But then they collect revenues in dollars because they're selling to the United States. Well, if you have to lower your dollar price so that net of tariffs, it's not a big price increase in the U.S., by devaluing your currency, what are you doing? You're giving your workers a pay cut. Not in yuan terms. They make the same amount in yuan, but if the yuan is worth less in terms of dollars than in terms of their own consumption of goods imported into China, they're a little bit worse off. So by devaluing the currency, you give your workers a pay cut and they eat the tariffs. So maybe the Chinese consumer who happens to have a factory job and finds that her currency is worth less in terms of US dollars, they may ultimately suffer. So my point being, it's really hard to pin down. You need a lot of data and a lot of time to analyze this, but whether it's Chinese workers, profit margins of Chinese exporters, profit margins of US importers, or all of the above, There are a lot of places for the cost to go other than the U.S. consumer, and the evidence is it did not go to the U.S. consumer. Meanwhile, the Treasury is collecting, hundreds of billions of dollars of revenue that wasn't in the budget. So this is a really good thing for the United States. It's sending a message to China, has not affected the U.S. economy that much. By the way, the inverse is true. Having a phase one trade deal is not going to boost the economy that much. We didn't suffer much in the first place. We're not going to get a big boost out of it now. It's good that it's over. The fact that you take it off the table is one more factor in favor of Trump's reelection. But the real cost of this is borne by China in terms of lost sales and lost profits. And that's why they had to throw in the towel and come to the table. Now, they will cheat immediately. The Chinese lie and cheat in everything they do. They lied to get into WTO and then proceeded to break the rules. They lied to get into the IMF's special drawing right basket, proceeded to break the rules by closing their capital account. So, the Chinese can't be trusted on anything, and they're going to lie about this. I wouldn't trust them on this new deal. But politically, it's a win for Trump. It takes away an irritant ahead of the election. It's good news for the stock market, but it doesn't really affect things that much.
James, even apart from China, we have issues with the economy, stagnating earnings. Target reported today that their holiday sales came in below projections. They're saying that the earnings for Q4 are safe, but the sales didn't meet expectations. What tells me, on the one hand, my wife doesn't shop at Target, I don't think, because those boxes must have come from somewhere else. But the other thing it tells me is perhaps the U.S. consumer is not as strong as the market was pricing in. The fact that earnings were not adjusted yet, the market was still disappointed, Target's down, Walmart's down, says that the market was counting on strong consumer spending, strong confidence. The consumer has been robust in past cycles, through Christmas especially. What do you think about sort of the consumer here going forward?
Well, the Target thing was big news, but what's difficult to sort out is how much of that was specific to Target with well over 1,000 retail outlets versus the economy as a whole. In other words, did Target's losses or lost revenue go to Amazon because people were shopping online? I don't have the data on that, but I would before I would assume that the consumer's throwing in the towel, I think we have to ask ourselves, well, is this just a trade-off between bricks and mortar and online retailers, or is it symptomatic of a decline in the consumer as a whole? Having said that, yeah, bad news is bad news. There's no ignoring it. I expect the economy, U.S. economy in 2020 to be, grow around 2.2%. Now, why do I say that? Well, the answer is that the average of the last 11 years is 2.2%. Trump's economy does not look that different than Obama's economy. You have people like cheerleaders like Larry Kudlow and Steve Moore and Art Laffer running around at the end of 2017, early 2018, saying, hooray, hooray, we're going to have this tax cut, and this is the Reagan Revolution all over again, and growth is going to blow past 3%, maybe even approach 4%, and it's going to stay there, and the additional tax revenues from the additional growth will offset the impact on the budget of the tax cut in the first place. None of that was true. I mean, when I'm reciting what other people are saying, don't think that I believe it, or, and more importantly than what I believe, what's actually true, what's actually in the data. The fact of the matter is Trump's economy in the first 3 years of his administration, 2017, 2018, 2019, looks about like Obama's economy, growth right around 2.2%. Some years a little higher, some years a little lower. People will point to a strong quarter, like the first quarter of 2019. I think it was about 3%. But Obama had quarters that were over 4%, more than one, and sometimes 2 quarters in a row, slightly over and under 4%. So if you average the 2 quarters, you get 4% growth. But the point is, it never lasted. It was always temporary factors, inventory, maybe a little pop in net trade, maybe a little pop in business investment, but it went right back down again. I mean, it would go from 4% down to, in the Obama years, down to 1%. But the point is, when you averaged it out on an annual basis, annualized growth year over year was about, I mean, I know the number is 2.23% for over 10 years. And so if you want a different forecast for 2020, which I don't, I think that's about where it'll come out. You have to, but if you are proposing a different forecast, you have to tell me what's different. Is there another tax cut? Not this year. Or, big change in trade policy? No, we kind of got what we got in terms of tariffs. Is productivity going up? No. Is population going up? No. And population is flatlining. To the extent that the U.S. is one of the few major industrial economies with an increasing population in the past 10 years, that was due to immigration. It wasn't due to births per 1,000 women of childbearing age. It wasn't due to internal increases in population. It was due to immigration. Well, Trump has shut the door on immigration. So there are pros. I'm not here to debate immigration policy. There are all kinds of pros and cons to that, but it's the case that if you reduce immigration, you reduce the workforce. As far as unemployment, it's about 3.5%. That's good. That's a good thing. Lowest since 1969. But those figures ignore people not seeking jobs. And I'm not talking about 70-year-olds. I'm talking about the age group 25 to 54 able bodies. So I'm not talking about disabled individuals or people closer to retirement. I'm talking about prime working age able bodied people. There are estimates vary, but somewhere between 7 and 10 million people in that category who are not working. They're not counted as unemployed because they're not seeking employment. They're not part-timers. They're not even underemployed. They're just home. Now, some of them are students. Some of them are homemakers. Not everyone, some of them may be rich and they're out playing golf. Not every one of those people is ever going to be in the workforce, but 10 million is a big group to be, kind of sitting at home watching football playoffs. So my point being, there is tons of slack in the labor market. And this is why, the Phillips curve is a joke, why Janet Yellen spent, 4 years worried about a problem that did not exist, specifically inflation. She kept seeing unemployment go down. She's actually a labor economist and statistician. She was never considered a monetary maven, but she spent some time on the board of governors in the Federal Reserve Bank of San Francisco. So she had some experience, but she's basically a labor economist. And so she believed devoutly in the Phillips curve. So when she saw unemployment, it was just a trade-off between, as unemployment goes down, inflation goes up, and as unemployment goes up, inflation comes down. That's, you just plot that. That's the Phillips curve. It doesn't exist. I can describe it, but there is no correlation between unemployment and inflation. She thought there was. So when unemployment was coming down, she kept expecting inflation to go up. She kept raising interest rates, handed it off to Jay Powell. Jay Powell continued that policy, almost sank the economy. We were getting very close to a recession at the end of 2018. Finally, Jay Powell got religion, saw what was going wrong. First, he put rate hikes on pause. Then he moved to rate cuts. And then he abandoned a balance sheet tightening, which was going side by side with rate cuts. We were supposed to ignore it, but good analysts didn't ignore it. And so we had a double tightening going on, raising rates and reducing the balance sheet. Powell stopped raising rates, started reducing rates, stopped tightening the balance sheet, and now he's expanding the balance sheet again back to a new form of QE, although he says, please don't call it QE. But the point being, that was a reversal of the dead end that Janet Yellen was driving down because she believed in the Phillips curve, which doesn't exist. So my point, which is simple, is that there is enormous slack in the labor market. I don't care what the official unemployment rate is. That's one reason why you're not seeing not seeing inflation. It's another reason why you're not seeing increases in productivity. So am I predicting a recession? No, I think there's almost no evidence that a recession is on the horizon, but I'm not predicting, the Larry Kudlow pom-pom, 3% growth either. I would expect it would just be, 2.2%, give or take. The problem with that is that the debt is going up, not 2.2%, but closer to 6% and on its way to 8% as a result of the tax cuts, as a result of increase discretionary spending for defense and non-defense items. So when your economy is growing, 2%, a little more, and your debt's going up 8%, you're going broke.
James, I think you make a good point about 2.2% growth. It's difficult to make a case for it being higher than that. I think you can make a case, and many have, that we should expect, at least on average, lower than that. So what do you think about that? How does that fit into sort of your projections for the next, say, 5, 10 years?
2.2% is, what the statisticians call central tendency. That's my forecast. But if I'm wrong, is it more likely I would be wrong that it would be lower or higher? Well, the answer is lower. It could be 1.9%. That's not my forecast, but it wouldn't shock me to see that. And there are very specific reasons for that. The reason is the global economy is slowing down. China is the second largest economy in the world. It's more than half the size of the U.S. economy. And it's the biggest buyer from places like Australia and Canada and Brazil and elsewhere. So, if China goes down, it takes a lot of countries with it. And growth is slowing enormously in China. A couple of things. The Chinese statistics are bogus. I said they're liars, and they are. So they've shown, the numbers they've published show growth declining from 10% to around 6.2% over the last several years. But the 6.2% itself is bogus, and here's why. About 45% of their total growth is investment, and over half the investment is wasted. I mean, just wasted. I'm not saying, you build a toll road and you didn't collect enough tolls. I'm saying they're building entire cities, not just one or two, but 50 or more around the entire country that are empty. And I've been to them. I've got mud on my shoes walking around construction sites in out of the way parts of China. I'm not talking about Beijing or Shanghai, but go south of Nanjing or go out in the countryside. I've been to cities all over China and Western China, and I've seen these ghost cities, and they all have a certain number of skyscrapers, apartment buildings, recreational facilities, golf courses, hotels, shopping plazas, public transportation stops, nearby airports. There's only one thing. They're empty. They're literally empty. There are no tenants. I was offered free rent in one place. They said, we just want you to come and set up an office so it looks like somebody's here. The paying rent was out of the question. Nobody expected that. And I met with Communist Party officials and others on these locations. So look, it's real steel, real glass, real copper, real asphalt, real cement, real workers. Those things are real, and they borrow the money to pay for all that, and those people get jobs at least till the construction work is done. And the cement manufacturers and the steel and glass manufacturers, they all get orders. So there's real stuff there, but it doesn't pay off. You can't pay off the debt. You get no return. In other words, it's wasted investment. If you were using generally accepted accounting principles, you'd be required to write it off the day it's open because it has no use and has no revenue. So when you take that out, so take let's say 50% of 45%, which is 22% of the whole GDP, that takes 1.5% off the growth right there. So now you're down to kind of 4.7, and then you can do further analysis. I've seen some analyses that by analysts that I have a lot of regard for that show Chinese GDP might be as low as 2.8%. So they have the same debt to GDP ratio, the problem that the United States has, but their growth is almost hitting the wall, getting dangerously close to recession in the world's second largest economy, which will have ripple effects all over the world. So that's the kind of thing that could slow down the U.S. if they just say, well, we're not buying Boeing, and we're not, I guess they have to buy the soybeans to feed their pigs, and they have to buy the pigs or pork anyway because they have swine flu. But they've got a lot of problems. They're covering it up. They're glossing it over. Western journalists, for whatever reason, don't really want to drill down on this. The Wall Street analysts are all conflicted. They're into the happy talk, but there are some analysts I would say, David Rosenberg, Michael Pettis, myself, and others who are, as I say, Lee Miller is another one, who are taking a hard look at this. And it's a very, very scary picture in terms of what's going on with China. So that's the kind of thing. And if you see the slowdown expand, Europe is practically in recession. They might not be in a technical recession, but Germany's growth is, close to zero. Italy's close to zero. France is doing a little bit better. Japan looks like they're heading for another recession. Australia's joined at the hip to China. So if China slows, Australia slows, and so forth. If you take all that, that could be enough to slow the U.S. economy, not to the point of recession, but yeah, sure, it could come in below 2.2% for that reason.
James, I'm going to try to remember to ask you if your financial models can predict football games before I let you go. We're quickly running out of time, though, so I'm going to slip in another question. 2019 was dominated, as you pointed out, by both the Fed and Trump, in particular trade. If I think most people, if not all, agree, if Jerome Powell doesn't do an about face, we're sitting at a very different place in terms of the stock market. And the interesting thing I find is that I don't know if President Trump gets enough credit for the way he sort of can manipulate outcomes or influence outcomes. He's very good at detecting people's pain points, whether it's labeling a political opponent, Pocahontas or small or something like that, right? Or sort of, I don't want to say sabotaging the economy, but certainly the trade war and the tariffs were a huge distraction and played a big role in Powell initiating the insurance cuts. So you can say it was the Fed and Trump, but really it was just Trump. And I wonder for 2020 what you think, and this is obviously speculating, but what you think his strategy is going to be. He's got a Fed he's trying to manage. He has the impeachment trial, and I'd like to know, what your opinion is on what the point of that is, and also the election. So take those three and let me know what you think about 2020.
Sure. Well, let's start with the Fed. The thing that's really important to understand about the Fed is they're always wrong. I mean, always. And that means that they're not guessing. They're systematically wrong. If you're guessing, you're going to be right half the time and wrong half the time. In binary outcomes, stocks up, stocks down, interest rates up, interest rates down. If you give a trained monkey a set of binary outcomes and ask them to throw darts, they're going to be right half the time. They're going to be wrong half the time. The Fed isn't even as good as a trained monkey. They're wrong almost all the time. And the reason for it is they have wrong models. Their models are badly flawed. And if you use the wrong model, you'll get the wrong result every single time. Going all the way back to, as far back as you want, the Great Depression, but even more recently, the May 2013 taper talk with Bernanke, which, caused an emerging markets crisis. And then Yellen saying at the end of 2014 that we're going to, it was March 2015, she took out the word patient from the statement, and that meant a rate cut was imminent. Well, we got the rate cut in December. So, she and Wall Street were wrong for 9 months between March and December. And then 2016, they forecast 4 rate hikes. I'm sorry, I said rate cuts before I was meant to say rate hikes. But 2016, they forecast 4. They did 1 in December 2016, and so on. Their economic growth forecasts have always been way off, et cetera. And so right now, what is the Fed saying? The Fed is saying they're on pause. They use these keywords, but pause is one of them. They did the rate cuts. They did 3 in 2019. And then they signaled that they're not going to do any more. Well, that means they're probably going to do one. So now they will not do one in January or at the March meeting in 2020. That they're not going to. They're certainly not going to raise rates. You can forget about raising rates. The question is, do they sit tight or cut? That's the issue. They're not going to raise. They're not going to do anything. They're not going to cut at January and March meetings, because it's too soon. After making these big pronouncements in December, it's too soon to reverse course. At the same time, they're not going to cut rates in July, August, or September because it's too close to the election, and they don't want to. They want to just back away, not appear to favor one party over the other. So if you can't do it right now because it would be embarrassing since you just got done saying you were on pause, and if you can't do it in the summer or fall because of the election, when can you cut rates without a political backlash? The answer is June. So my forecast is they're going to cut rates in June. Does that mean that somehow we've hurtled, into a recession or growth is horrible in June? No, it doesn't mean that. But what it means is that they want to take out another insurance policy, and you use the word insurance. I think that's the right word. They don't really know what they're doing, but they sure don't want to cause a recession, which they almost did at the end of 2018. So I would look for a rate cut in June. That's not priced into the market. It's not what the Fed is saying, but the Fed will get to closer to June, March, April. They'll see the growth numbers, kind of thing we were just talking about, and if anything, those numbers may be below expectations, and they'll say, hey, our hands are going to be tied in July, August, September, October. We're not going to be able to ride to the rescue. We don't like what we see. We better, take out an insurance policy, and that means a June rate cut. Now, at that, since that's not priced in, what does it mean as that becomes more apparent? Well, it's good for stocks, so that's going to give the stock market a boost. And what does that mean? It means that Trump's going to be on his way to re-election. I have election models. I don't have sports betting models, by the way. I'll leave that to Nate Silver. He seems to be better at that than he is at politics. But I specialize in politics and the economy, so I have proprietary models that do look at election outcomes. And right now, I'm giving Trump a 70% probability of being reelected. Candidly, it should probably be a little higher than that, but I like to be conservative. But there's a theta, time decay element to it, in terms of one of the major factors, which works in Trump's favor. So I would expect his probability of being reelected goes up, about 2% a month for the remaining 10 months before the election. So I expect to see him at close to 90% by election day. There are a number of factors in the model, but the biggest single factor is that the probability of Trump being reelected is the inverse of the probability of a recession before the election. So just ask yourself, what are the odds of a recession before, let's say, September 2020? Right now, they're really low. They're in 3 months, it's kind of close to zero. And even in 10 months, it's not more than 20%. So you take the inverse of 20%, it would be 80%. I said I'm giving Trump 70%, but maybe it should be a little bit higher. But every month that goes by without a recession, the odds of a recession before the election are that much lower, which means that Trump's reelection chances are that much higher. Now, there are a lot of other factors, but that's the biggest single one. So obviously, Trump's going to be reelected. It'll be a bigger margin of victory than the last time, but the biggest single factor is the odds of recession. But coming back to the Fed for a moment, that Fed rate cut in June, which I am forecasting, will be the recession insurance. And look, and remember, Trump owns the Fed. I mean, Trump came in. There were 2 vacancies when he was looking around. He keeps talking about judicial vacancies. He couldn't believe how many Obama left. He said, what do I got, like 10 or 20? He's like, no, Mr. President, you have like 150. And he and Mitch McConnell have done a really good job of filling up the seats. Well, the same thing on the Fed board. By the way, Obama did all this because he thought Hillary was going to win. And so she could pick safe seats. It was kind of a gift to her, but it ended up being a gift to Trump. So right now, every member of the Board of Governors, by the way, there's still 2 vacancies. They filled them in, but the other people retired. Stan Fisher left and others left. But right now, every member of the Board of Governors was either handpicked by Trump, or in the case of Jay Powell, promoted from governor to chairman by Trump, with one exception, which is Lael Brainerd, she's a big brain, and they really need her on the international side. She's a Bob Rubin protege. She must feel like a hostage in the boardroom because she's the only Democratic nominee. But the rest of them are all Republicans. Now, I'm not saying that the board of governors of the Fed is going to get on the Trump reelection campaign committee. I'm not saying that. I'm just saying that they're Republicans. And at the margin, if you got any doubt at all, and you certainly don't want a recession that's laid at your feet, you're going to cut rates, and that's going to be a very nice boost for Trump. So between the low probability of recession, another Fed rate cut, peace in the trade wars, and as I say, rising stock market, better 401ks. Looks like and the impeachment. Oh, you asked about impeachment also. Impeachment will be over soon. It just favors Trump. It just does. And here's why: impeachment does not change anybody's mind. If you hate Trump, you still hate him even after the impeachment. If you love Trump, you still love him even after the impeachment. And if you're undecided, you're probably still undecided. And, you may, I think on balance among the undecideds, there's a slight tilt that the impeachment process was unfair, which it was. I mean, in addition to doing economic analysis and writing and a few other things, I'm a lawyer by training. I spent 40 years as attorney on Wall Street. And so I know a thing or two about the Constitution and due process, and the Fifth Amendment, the Sixth Amendment, and right to counsel, right to cross-examine witnesses, right to confront your accuser, et cetera. And a due process generally, all of those things were denied to Trump. I think you can make a good case that the impeachment itself was unconstitutional, but that's not going to get litigated. Save that debate for another day. But the bottom line is, I think people see the unfairness of it. But it doesn't really change very many minds. But here's where it does affect the election in a very substantial way, which is turnout. The Trump haters hate Trump. The Trump supporters support Trump. That's not the issue. The issue is who's going to, kind of get up on the couch and go out and vote on a cold day in November, or at least cold in a lot of the country. And the Trump haters, in some ways, they got the venom out of his system. They started in 2016. We got to impeach this guy. He has to be impeached, and they never stopped. Well, he was impeached. Okay, that's over. So in some ways, you got that out of your system. You're like, okay, well, now I can go back to my normal routine. But for the Trump supporters, they have something to prove. The easiest way, Trump will be acquitted in the Senate and he'll be exonerated, and that's good. But the easiest way to show that impeachment was a sham is by reelecting Trump. Because remember, the two prior presidents have been impeached, Bill Clinton and Andrew Johnson. And Nixon was heading that way. He wasn't actually impeached, he resigned, but it was heading in that direction. But none of them were up for reelection. Nixon and Clinton were in their second term, and Andrew Johnson wasn't running for reelection. But Trump is. And so here we'll have an impeached president asking for votes, and he's going to get them. And so I think that would be a major motivating factor. Turnout will be stronger. There are other factors. I mean, I don't want to go through every one of them in the model, but the African-American factor is huge. Now, African-Americans have, for a very long period of time, split 90% Democrat, 10% Republican. I know a few of the 10% Republicans, but it's a small group. So 90-10, you just take the African vote for granted. And African-Americans are the African-American vote. And the African-Americans are about 12% of the electorate. Well, it's not going to move to 50-50 anytime soon. But let's just say it moved to 80-20. Instead of 90-10, it was 80-20. So you picked up 10 percentage points of African-American votes. Well, if that's 12% of the electorate, 10 percentage points is 1.2%. Well, our elections are only being decided by less than 1%. So if you swing 1.2% in places like Detroit, that gives you Michigan. Pittsburgh, it gives you Pennsylvania. Milwaukee, it gives you Wisconsin. You could see Trump running up an electoral college landslide. And that's a big factor. So just a lot of things going Trump's way, and I don't see anything that will turn that around, except a recession. But the probabilities and the indicators of recession right now are extremely low.
James, you make so many good points. I wish we could keep going, but I know you're out of time. So thank you very much. My guest has been James Rickards, author of Aftermath, 7 Secrets of Wealth Preservation in the Coming Crisis. He's also a keynote speaker at the 2020 Sprott Natural Resource Symposium in Vancouver. Details at sprottconference.com. James, it's always good to speak with you. Thanks for coming by again so we could catch up.
Thank you, Albert, and I'll see you in Vancouver.